Greetings, I'm Keith Klein, the host of the VentureFizz podcast, where I interview the most fascinating people in the tech scene. This is episode 379, and today's guest is Graham Brown, managing partner at Lerer Hippeau. It seems like just yesterday when I first interviewed Graham 7 years ago, back for episode 32, when Lerer Hippeau was announcing its sixth fund. This puts Graham in a lead company as one of the very few people who have made a repeat appearance on the VentureFizz podcast, which I'm sure is an incredible honor for Graham to achieve. Just kidding, obviously. But in all seriousness, in that first interview, we discussed Graham's background story. He's actually a fellow native of New Hampshire, like me, and the early innings of his career. So in this interview, we were able to go much deeper into other topics around startups and fundraising. As you might know, Lerer Hippeau is one of the top early-stage VC firms in the country, and they recently announced another new fund, that being Fund 9, a $200 million fund, which is exclusively focused on early-stage companies. In this episode of our podcast, we cover lots of great topics, like how to land a job in venture capital, how our original interview discussed AI 7 years ago, and what Graham is excited about in terms of this platform shift, the renewed interest in energy startups and the innovation in the sector, what he's looking for out of a first meeting with an entrepreneur and the process of getting funded, PLG versus founder-led sales and advice on avoiding entrepreneurial envy, the latest on the New York City tech ecosystem, and so much more. All right, now a brief word from our podcast sponsor, Silicon Valley Bank. I'm excited to share that this podcast is brought to you by one of the strongest longtime supporters of the local startup ecosystem, that being Silicon Valley Bank, a division of First Citizens Bank. SVB serves innovative tech, healthcare, and life sciences companies, including 60% of CNBC's Disruptor 50 list, 72% of Forbes Cloud 100 list, and 48% of Forbes AI 50 list companies. With more than 1,500 bankers and relationship advisors and $42 billion in loans through Q2 2024, SVB delivers the right people, service, and resources to support your entire financial journey. Learn more at svb.com. All right, without further ado, here's my interview with Graham. Graham, thanks so much for joining us.
Keith, really appreciate you having me.
So you are part of this exclusive club now. You know, Saturday Night Live has their 5-time hosting club, the 5-Timers Club, with like Steve Martin, Tom Hanks, like all these great celebrities that have hosted Saturday Night Live 5 times. Well, you're part of the Esteem Club that is now a second-time guest on the VentureFizz podcast.
I appreciate it. You know, I have to question your judgment for including me 7 years ago, but I appreciate you having me back.
So that's the crazy thing. You were a guest on episode 32 7 years ago. I'm like, I've really been doing this podcast for 7 years now. Wow. Okay. So we have over 370 episodes. It's an amazing catalog. Instead of people going to Wharton or, whatever B school, HBS, just study the VentureFizz podcast. It's all right there. If you want startup MBA, it's right there.
So get the education there. Yeah, it's pretty incredible what you've done with this. And yeah, well, you've 10x'd, so it's a good rate.
All right, so history. Back in that point of time, Lerer Hippeau had its sixth fund that you were talking about. So it was, I think, a $122 million early stage fund and maybe a $60 million select fund. And 7 years moving forward, there's a new fund. So I'm going to talk about your background, but I'm going to do the quick rundown just so people have kind of like a summary view of it. I'm going to put in the show notes the full podcast episode where you went deep on your background, but you're originally from New Hampshire, Ware, New Hampshire, which is near and dear to my heart because I grew up in New Hampshire. My dad, he was an entrepreneur. One of his facilities was actually in Ware. And I think there's like a nucleus of New Hampshire venture capital thing going on because Joe Medved is also from New Hampshire. He was from Manchester, right?
Yeah, he is. We are like two of a very few at one place. Not by design, but good New Hampshire people find good New Hampshire people, I guess.
Exactly. You went off to school at Colby, great school. Started out in investment at Concord Capital.
It was called Adams Harkness. It was this tiny boutique.
Okay.
The econ major, philosophy minor. Where am I employable? It was sort of it was a great place to start. It's been acquired now a number of times.
Okay. Off to Polaris, from Polaris, you joined a portfolio company, Lifeline Screening, went back to B school at Columbia, SoftBank, to Lerer Hippeau. Is
That's
that
right.
accurate?
You nailed it.
Okay.
I should have you just deliver this for me.
All right. So again, if you want to hear the full story of Graham's career and how he got there, listen to the first episode. But I did want to start off with the leap into venture capital, because I think that is something that people are trying to figure out. Like, how do I even get started if they're interested in joining the investment side? Like, from your early beginnings of landing in this industry to maybe what it looks like now, maybe it's different. Like, what advice would you have for people that are, looking to explore that type of career path?
Well, it's a dramatically different industry. It's much, much, much larger, right? I think, fair to say people would have characterized it as a cottage industry. When I first joined in 2008 in many ways, and it's, much more mainstream now, much more awareness. And there's also just endless resources and information out there about it. And so like you can self-learn in a way that um was very different than when I got started. I was in the technology group at a place that worked with, you know, early to mid stage companies and, did some coverage on digital media and, SaaS, which was emerging at the time, on the public company side. And, through that, I got to meet some local, investors in the Boston ecosystem, in venture funds. And it was, like, oh, that looks like the fulfilling thing I really want to be doing with my career. But it was much less like I was able to endlessly research and learn about the industry. And a lot of the great books on, venture, written both by, investors and academics, like they didn't exist back then.
Yeah, there's so much information out there. If you're hiring an associate, senior associate, like what do you generally look for now?
The there's certain personality traits, especially seed. The interpersonal dynamics and skills are incredibly important. But I think it's, there's creativity, there's the sort of comfort or ability to learn and grow in a not super structured environment. We're still a small team. There are larger funds where, I think there are much more structured programs, but we're looking for somebody who's going to sort of thrive and be a self-starter, and I think bring their own ideas and help fit some of those to our existing platform and network. And clearly, like, there's a lot of guidelines, and we're doing shadowing and we're working together. But I think some of those attributes are just absolutely critical. The I think that we think a lot, and we think about this as founders too, is sort of like the trajectory, and where that person is on that trajectory and what the potential is. Our how we think about fund and long term is, the next associate we hire may be, a managing partner in the future. And so it's not about fulfilling a role today. It's about what that person's long-term potential is. Can they be a great early stage investor, and, can they just continue to grow? I think a lot about, again, sort of both founders and people we hire, but like, Charlie Munger's got a great concept of learning machines, and that, like, each day you're getting better and smarter than the last. And, that continuation is more important than any single moment in time, how impressive an individual is. And so, yeah, I think there's a bunch of factors that go into it. And, clearly, like, a curiosity and an obsession with the different elements of venture, especially since it is so accessible now. That coming in is going to be like, that's an important signal. And so we try not to put like too narrow of like the person has to look like this and comes from this background, because I think great investors can come from a wide range. We have a wide range here. And so, a lot of the sort of like dynamics and ability to, network and interact with founders and build trust. Like, I think there's sort of like some fundamentals that are going to be important, but ultimately it's going to come down to like, where they are today, where we think the potential can be, and, the addition to the firm versus sort of redundancy. And so, like if the sort of next question is on advice, like I think there's like, and people do this, we're a generalist fund. And I think, carving out areas where you understand more or bring something or bring a perspective is just incredibly valuable, right? Because there's sort of an endless number of really smart, really impressive resumes and people out there. It's how do you set yourself apart and what are you bringing? And what does that say about, you and your curiosity and your, obsession with, the job you're going to look to start. And so a lot of those things are just really important.
Would it be time well spent? Let's say your firm is hiring and I'm, eager and I have a curiosity factor for AI and how it's going to improve healthcare operations, that I would start to do a lot of market research, build a thesis. Maybe I've even have some history in healthcare, and then talk to founders that are building and almost like start to do the job without actually doing the job without, money, but you're starting to recognize kind of, those conversations and the market research, recognizing the patterns of the companies, and then approaching your firm and saying, hey, look at all this work I've done.
Yeah, I think it's, so I think that type of initiative is smart. And I think it depends on like, what's the role you're applying for and what, who's the audience. If you're looking at a specialist fund that does, a vertical or a few verticals or a set number, a set number of theses, like coming in with your own perspective on, an existing thesis or a new thesis area or however you want to position it is, I think really valuable. For us, like having something insightful on a market and a market opportunity and where it's going is like, I think that's really interesting, right? But it's sort of like, you can't do it halfway. It has to be good. otherwise it hurts you. But I would say on, when we hire associates, I don't think we've hired an associate that hasn't like hustled and sent us interesting founders and founder ideas as part of that. And, that is without a platform and without like, that's just like pure hustle and ambition. And, there's, it's not about us like seeing that company and making it an investment, but like, you sort of see what a rough view of that person can be at a really early stage. And, I think that's sort of, that initiative and being that proactive is really valuable for that level of process. And I think like, again, like some firms are going to have very structured processes that are, particularly at the later stages. But at the early stage, it's about people and ideas and markets. And so to the extent you can show a point of view and something interesting there, that's going to help you stand out.
Yeah, well, no doubt. All right, well, let's talk about the latest at Lerer Hippeau. So you have a new fund. So what are all the details there?
Fund 9. Fund nine. Yeah, I mean, it's the common thread in focus for us is seed. We include pre-seed in that, but like seed only and working to continue to improve. There's no such thing as perfect, but like always improve that product for founders. And this is a continuation of that. The fund is solely focused on partnering with founders at the seed stage and leading seed rounds. And obviously continuing to support, but like, every investment being very meaningful and us, you know, as closely aligning with the founders as possible at that early stage. Like our first check is our most important check for the fund, and that means something. The the fund itself is 200 million. Our last fund was a little over 140 million. So this one's a little bit bigger. The strategy is the same. I think there's this gives us room to do more with founders, and make sure that, as the market changes and competitors, other investors, everyone's a collaborator for us. And, at the same time, you can compete with anyone. But making sure like we are in a position for the type of seed investing we want to do, where we have the ability to bring, resources and the amount of capital that's right for that founder. And then also support that founder through, the winding path of getting, to product market fit and raising a Series A. And we'll come in early, like, we'll come in, especially with people we've worked with in the past, like very much at that sort of idea maze foundation discovery moment. So we're comfortable coming in, as early as you can at the entity formation stage.
And, this is April 2025. There's a lot of questions out there with the market. So you close a new fund. Like, what's the vibe in the LP world these days?
So there's like there's constant shifts, and there's shifts that have happened already since we raised that fund. But I'll talk about a little bit about, during our process earlier this year. I mean, I think there's still a lot of appetite and interest in innovation, in strategies that, those LPs believe in. There's also been little to no liquidity over a period in that, for those that already have a built-out portfolio, that that means something. There's not capital coming back to reinvest, and so unless growth is coming from somewhere else or the strategy shifting, there's things are going to be tight. It's going to be more difficult to add new managers, and so there's certainly capital out there, and setting yourself apart and sort of standing for a product or something is like incredibly important. And it's, a market that, I think looking forward today, you can't fully predict the future, but like it's been getting harder, and it's going to likely continue to get harder until, things change and there's more liquidity again, whether it is, secondary becomes healthier and more viable, whether it's M&A, whether it's public markets, or all of the above. Like, some of these things have to, come back into the pool for it to be an easier fundraising market. But I don't know. I don't think it's a bad thing. Venture was without a doubt overbuilt in the lead up through 21. Clearly, like, lots of great new entrants, but also just a lot of tourism, a lot of sort of side strategies, a lot of things that were not good for the long term, and even if it seemed so at the time, not good for founders. And so, I think that part's going to be in a healthier place. And yeah, I mean, there's recent changes and unknowns that could, further impact fundraising in the future, with denominator effects and um, tax exemption statuses, which is not something that I think people thought they'd be talking about. But like, there's lots of unknowns.
Well, the it reminds me of 2009, where it's supposed to be hard. The whole chain is supposed to be hard, from raising a fund to deploying the capital and making bets on the best of the best that should be raising capital, that have a well thought out idea, maybe some traction, who knows. So we're in the early innings of a platform shift. So, I'd hate to say it, but there's probably never a better time to be deploying a fund that you have than now, right? Like, we're in the early innings. The defining companies of the last, mobile shift, and, just Uber and Airbnb, like, these companies were born in that era of just gloom and doom. So I'm an optimist, and I just think, this is that next cycle of the down that will eventually see market winners come out of the fund that you just, not just Lerer Hippeau, but across the board. The firms that have the resources to deploy capital now and seed Series A will definitely, if they make the right bets, see a massive uptick in that fund performance.
Yeah, I couldn't agree more. I think that's well said. You know, we feel incredibly fortunate to have just a phenomenal group of, very supportive and collaborative LPs, and we have certainty with this fund, and certainty in a time when, right now there's macro unknowns and micro unknowns at the same time. Both are substantial. In those periods of sort of, disconnection of previous assumptions and fast and like rapid changes, it's, it's both the most excited I've been to be investing at this stage, and the most terrified. But like, it is there are going to be really, I think, phenomenal companies that have not yet been built yet. It's a lot of yets that have not yet been built, and like the world is set up in a really interesting way for that, right? And especially as you get companies that narrow, if things get harder, you have companies that start to narrow their focus, which can create more opportunity for new ideas and new opportunity, like and founders to solve, existing problems in better ways, new problems or new opportunities we're not thinking about. Like, it just becomes just such a great moment. So yeah, we've seen just I think a level and an ambition and a diversity of, founders over this past cycle that are just phenomenal. And we're all really excited for, Fund 9 in this vintage and in the years to come as well. And so it's yeah, I think back to earlier, it's like as excited as I've ever been to be invested at this stage, and huge amount of unknowns and a lot of change. So.
Well, there was a long period of time that your firm was mostly recognized by investments in consumer, but that is certainly not the case. When I was listening to our podcast from 2018, you were actually talking a lot about AI and advanced computing then, and it was specific to healthcare and one of your portfolio companies, K Health. So, you know, sector agnostic was the theme from the get go there. So what do you like? What are you looking at now? Like, what are you excited about? You talked like now's like you're never been more excited. So, like, what are you excited about?
Yeah, and a lot of it, like, we follow talent versus prescribing our own ideas onto where exactly we need to invest. It's incredibly important to come with a point of view, be willing to change that point of view, but you know, incredible founders are going to lead us into new areas that we aren't thinking about or looking for. And, that's part of the benefit of being a generalist and, setting up that strategy since when I joined. And, today there's, we're seeing a lot within healthcare again. There's, I look at the work. We should talk about K Health for a second because the work they're doing is incredible. They're now partnered with Cedars-Sinai, Mayo Clinic, Hackensack, Hartford, of a number of other very large partnerships lined up, and they're, bringing clinical AI to the market in a very real way. And the data that they released recently is, it's pretty phenomenal. And they're, empowering providers to, be the best versions of themselves. So it's sort of a really exciting. When we spoke, maybe that we were a year in. And so it's just been incredible to see that, company and that team build and evolve and, find the path to distribution in the right way. And they've just done a really incredible job. And it's a good reminder of when we last spoke 7 years ago, that was like the very early days. We weren't talking about AI in the same way that we are now. But I think excited about a lot of opportunities in healthcare, and not just sort of like admin and business automation functions. Like, yes, there's like a better, more compelling version of RPA that's happening, and we're seeing companies with. I think it's interesting. We've invested and been behind some of those, but I think in terms of like solving some of the bigger problems with regards to access, quality care, and costs, I'm really excited for companies that can be built there, that are being built there now, and for that change. And another category that we've been investing in for a while, and maybe the last year was a little more quiet, but starting to see some really interesting ideas and founders again, and sort of a new generation of opportunities is on the energy. I think both distribution side as well as transmission side, but there's a lot of really talented and ambitious people going after opportunities, and with an infrastructure that looks very different than it did in 2018 when we spoke. Maybe we had just invested in Palmetto, or it may have even been before we invested in Palmetto. You'd have to check the track whether we spoke about it or not. But the progression, the implementation and deployment of distributed energy in the residential market, like night and day from where it was. We're still like barely scratching the surface. And one thing we need now is we need power. It's a sort of like, where's the limiting factor? And if we don't solve that in creative and smart ways, that's a limiting factor. I think everything around that, including utility scale things, residential C&I, obviously, there's just been a lot of areas where you've now got the sort of penetration and footprint where there's, an opportunity for data in infrastructure and then app layer. And right now, app layer means like AI applications in many ways. Like that is still to be built. And it's, immense. I think there's like very powerful long-term tailwinds behind it. And right now, increasing power access, like the fastest way you can do that is going to be solar and storage. We should be investing in other areas as well, but like right now that's speed, cost, and your input is free. You're not digging it out of the ground. It's not a resource that has to be extracted. It's how much more efficient can we get with the technology to make the harnessing of that power even more valuable. So like I think there's a lot there, and maybe the last year it felt a little more derivative, a little overinvested. Right now it feels very exciting again.
How much are you seeing with like repeat founders, right? Like founders that built something but now see this platform shift and they're like, wait a second, this is something that I can really, sink my teeth into, build something to the next level beyond what maybe they built before, even the same success that they had. You talked about the application layer with AI. Like today, I was reading TechCrunch or wherever, but OpenAI is reportedly buying Windsurf for $3 billion. So it just seems like that's going to be a mad rush of this application layer.
Yeah. So the answer is we're seeing a lot. I think Fund 8 is close to a quarter repeat founders and like exceptional talent out of prior portfolio companies. And so that's a big part of it. And yeah, there are very few pitches these days where AI is not part of the why now. I think what matters is like the insight and perspective and the human behind that and all that goes into it. And we love seeing folks that we trust and we know how they execute, and we've seen them adapt and go through hard things, like seeing identifying an opportunity, oftentimes based off of, lessons that they learned over their previous journey and starting something new. So it's a big part of Fund 8, and I imagine it's going to be a big part of Fund 9 as well, just as our network continues to grow with each fund.
I hope you are enjoying this interview. Just a brief word from our sponsor. As a longtime champion in the local startup ecosystem, Silicon Valley Bank supports innovative companies with the solutions and financing they need through every stage of growth. With more than 1,500 bankers and relationship advisors and $42 billion in loans through Q2 2024, SVB delivers the right people, service, and resources to support your entire financial journey. Learn more at svb.com. So what do you expect to get out of that first meeting? Because like you said, every conversation is probably going to have some element of AI now. It's like electricity, water. It would be shocking if it wasn't part of the overall strategy. But what's the key criteria that you're looking for out of that first meeting?
Yeah, I think it's I'll be at a higher level because I think that's most helpful in looking at, across a wide variety of pitches versus sort of more particular and nuanced things. I think there's like the sort of why now, why this team, or sort of why you, and if we're right about the people and the timing, are we in a market that is growing and changing sufficiently fast or large enough to support a really exciting outcome for us? And those like sort of three factors are going to influence it a lot. But there's with the team, you're trying to get a sense of how special, how unique, where they are on their trajectory, what's that like, how much is left, why there's not going to be a plateau. Right now there's a big premium. I think it's always critically important, but like there's a big premium on adaptability because we don't have a playbook that has been formed over 10 years for how you build and then defend a SaaS company from competition. Like this is new. We're all dealing with new, and the underlying power of what we're building on is changing. And so I think that adaptability and speed at which an individual can navigate that is at a real premium right now. And I think largely, again, this is a generalization, but like coming out of that first meeting and like, you, and then you are looking to validate or invalidate, right? For the most part. It's a, for the majority of companies that I invest in, after spending that first hour, like I'm working, it is if I really want to spend more time, it's a confirmation of, what I believe to be true about that team and that opportunity, and, ruling out objections. And so it's, a lot of that obviously is critically important. And part of that is just time is the scarce resource here. And so, spending multiple meetings, like you come in high conviction after that first pitch. And it's not always true. Some things are a slow build. But I think by and large, like that's if I can get a phenomenal read, or not a phenomenal read, if I get a read that, these individuals are phenomenal and have a real right to win and have a perspective that I haven't heard before. And, the ambition is there, like the specific questions asked are all getting at the same general things that we need to believe for making an investment. So yeah, those pieces are just critically important.
And so what is the process, like the formal process that companies go through to eventually, term sheet and then wired capital?
Yeah, I mean, it's we've specifically designed it around a process that supports individual conviction, but also not lone wolf. And so any investment we make will meet with more than one partner. They will meet with at least one managing partner. And we, have flexibility so that it's not, leading up to come pitch the whole team at a partner meeting and then make a decision after that. It's the partner who is leading it. It's going to be driven by their conviction and, working through questions from the group, and there will be other eyes on it. And a lot of that's sort of like the validating, like when I think about if I see something I really love and having a partner do a fast follow, a lot of it is like, do you see what I see? Am I, do I have a bias or am I blinded by something here that I need to be made aware of? And so it's, it's about validating a yes versus confirming a no, right? Like, I'm not sure, maybe. Could you look at this and, help me figure out if I should say no here? Like that's that's the misuse of time that you've got to avoid, right? Human, a lot of the business is saying no, and that sucks to say no to people all day long. But doing it quickly, kindly, and in the right way is going to be the most valuable thing for both sides. And so, and so like, what does that mean? I mean, we want to get to know people. You don't always have a ton of time, right? And so I think in anything that we are excited about, we're going to move urgently to get to a decision as quickly as possible, right? And so, if our goal is to get to founders and have a relationship before there is a process and to get in front of that. But like, we can move as quickly as process demands, and and also on a timeline that makes sense for founders. I think there's like plenty of cases where we meet somebody who has not left their previous role, and we'll like ideate and build a relationship over time and a perspective so that, when that time's ready, like we are ready and there immediately. And so our process is specifically built around flexibility, and then it's conviction driven versus sort of everyone agreeing that something is good.
So once a company's in your portfolio, like what advice do you give to founders around hiring that early stage team?
Well, I mean, now what you are doing matters in the volume of people, but like you can do a lot with a fewer number of great people. And so, I think a big part of it is, and we have a head of people that like on the strategy, on, the resources, the tech stack eventually that you need to build out for, not just today, but for growing into tomorrow. Like those are all things that we're involved with and advising. We're helping to match great talent and also helping founders to close great talent, right? That's part of our role. And, giving a perspective to help them keep the bar very high and, being thoughtful about building the environment and, cultures. It's overused, but what you set in the early days is very hard to change as you grow. And you're convincing people to, work for less money with equity that is like, could be worth something someday, but like really like you want to build a group where everyone is impressed with the other people they're working with and wanting to work with them because it's fulfilling, right? And by having and maintaining a very high bar and making quick decisions when something is not working out is the way to do that. And so we are, there's certainly not one prescriptive thing like hire this person, that person, and the next person, right? But we are working with the founder and a perspective from, a people leader on where are the roles that we need today, where are the roles that we need tomorrow, and what do we need to do to get to that future state, and who do we need on the team? And so in the early days, a lot of that, I'll speak for where I mostly invest, which is, more on the B2B side. A lot of that is on the technical side and the product that you're building. And then it changes over time to your go-to-market. But in those very early days, there's the founder is generally doing the selling, the motion, the learning, the feedback to product. And so it's building, it's getting the right people in place to, build the right application, and get to, first one delighted customer, and then, increase that aperture and bring on some more, and then scale it up, right? I don't know that we're not dogmatic on how long it's founder-led sales. Depending on the sort of DNA of that founder, sometimes it's going to last for longer, sometimes it's going to be shorter. But in those early days, it's going to be largely on the the product and technical side.
Yep. So the go-to-market side, right? So once we kind of hit that point, like you're starting to see or hear about companies, and you're just like, as a founder, it must be like just challenging to hear. Like, so Bolt, they generate 40 million in ARR in 5 months, and you hear all these other companies generating out, fastest company to ever hit 100 million in ARR, and they don't have a large enterprise sales team, right? So how's the go-to-market changing, or like, what's the advice from? I mean, I know it depends on company and what they're selling and to who. Bolt's obviously its own world of what they're doing, but
Yep.
what's the go-to-market advice these
I mean,
days?
a lot of those like sort of mind-blowing quick, like those are product led, right? And in many of those, like it says something if you are growing that fast, right? We're in a different world than we were in a few years ago with selling software. But it also says something about what competition can build in a short period of time, unless you happen to have like the only one person in the world that can build that. But that's not the reality for these, more sort of mainstream use companies that are seen as exceptional growth. Of course, they have phenomenal people. But the sort of like what you've proven to get to revenue is very different than it was 10 years ago, 5 years ago, even 3 years ago. It's about how you adapt and figure out your moat over time. For founders building now, I think it's just you got to sort of like you got to avoid envy and thinking like seeing somebody else means that's what you have to do. It's really hard, right?
Yeah, that's
Such
good advice.
ingrained human behavior, and it drives so much. But like that's okay, right? You like, unless you're building a exact copycat of that company, like don't distract from the focus of what you need to do and prove, because of like the company or companies that get announced that are on that exceptional growth, raising at 10 billion. Like that's not what you have to do to be successful. And I think there are certainly enterprise AI companies that have grown, but that like under a year, some of those numbers that you mentioned, like that's a PLG motion, which is pretty, it's pretty incredible. And it's sort of like it's a new part of the cycle. We've obviously been talking about PLG for a long time. And now you see some of these cases where like the use and value is so powerful that you can get to $100 million a year.
That's crazy. All right. Well, what about New York City? Like, so there was a point in time where people were like, you can't build a startup there unless it's maybe consumer or fintech. But That is purely not the case now.
Not the case. Yeah, not the case. I mean, it's grown so much in so many ways, right? And like what, like it remains half of what we do, maybe a little more. Like we're very active here. We've got just a huge and really powerful group of and community of founders here. So it's highly relevant to us, but there's no longer convincing people that it's going to be a, a large and durable and growing market. The, I think as like looking at the future and sort of extrapolating out, you know, different tailwinds and changes in the market, like it continues to be a place for phenomenal young talent. And, that young talent, whether today or in the future, there are folks there that will be building future companies. And, if we're spending most of our time at the application layer, like how we implement and build applications with LLMs and what we can do with the foundation models. And so I really like that future. And then what's been built up is an ecosystem that can support it, right? If you can have great talent, New York's always had great talent. It's how much harder was it to build and fundraise and do all the things that's already incredibly hard? 15 years ago, it was really hard. Now you have, from pre-seed to late stage, you've got access to capital, you've got talent pools, you've got exited like founders that have been very successful, founders of very large companies that are still operating. Like you have an ecosystem that can support a paradigm shift or a big technology shift in a way that like there are some great companies built in New York off of, cloud and off of mobile. But like at the time, some of the most interesting things were starting and being built. Like it was not an ecosystem that could support founders in the way it can now. So I think that's really exciting. The one other factor I see, and we've done some of this, K Health is an example. We have a larger company called Augury, which is an example. Pros on the consumer side is another example, but New York being a great location for European teams, and whether that's one founder's in New York or one founder's over there, or whether that's they're moving everything to New York, we've seen a lot of phenomenal talent coming from there as well. And it's all related. There's like a bit of a virtuous cycle. Is like that becomes more attractive when there's more capital and support there, which comes when there's more founders, and so it's sort of it all plays off each other. We it's no longer a question. Or it's no longer it was the question for a long time. And yeah, we're not surprisingly incredibly bullish about the city's future and innovation in the New York area as a hub in the United States.
All right, 3 apps you can't live without. Can't be email, calendar, or Slack.
I could live without all of those. I couldn't function. I could live without. So I will give you right now. With a Chat GPT, I am using deep research and playing around with it an immense amount. There's obviously some challenges in that, but it is overall phenomenal. And the speed that you can learn and sort of build a baseline understanding that then you can then go deeper on from there it's incredible. So I've been using that like daily over maybe not daily actually over the last month or two. Quill is another one. I think Granola gets a lot of the hype and the UX UI is amazing, but Quill, I think we've found, well, there's a sort of a security element for using it as a team that's important, and we found that right now, this may change in the future. They've got one of the best, if not the best, note-taking solution, and so that is the sort of transcription of conversations and the ability to be more present in a conversation because you don't need to feel the need to take notes, and then how you can extract off of that, I think is very powerful, and that's dramatically changed the day-to-day at work. Last one, non-work related. I mean, this is a boring one, but like I have 3 boys under 5 right now. Actual reading a book is largely like what I do and then fall asleep after getting through a couple pages. And so I've been using Audible a lot recently. And I found it, I recently moved to a place where I commute in. Like I found like just the ability to learn and get through some great books, and retention's it's not as good as reading on my Kindle or a physical copy, but it's been surprisingly good, and I've been spending a lot of time in Audible since I moved, and now have a daily commute, which was earlier this year.
It's great. Yeah, I burn through a lot of audiobooks on Spotify. It just, once I realized that was there and it was included in my family plan as the primary account holder, I think they give me 15 hours a month. I was just like, wow, okay. So I was able to get rid of Audible and just, everything's on Spotify now. So
Spotify is, and yeah, it will. There's a few things I have but like it's going to replace it, and it's obviously where I listen to all my music. So
speaking of music, and maybe this is a silly question based on what you just said with the family, but are you still playing the piano? That's how
I
we
think
ended the
the answer
conversation.
to that. Yeah.
Didn't quite take.
No, like that's taken a break since, in how do you get to 3 boys under 5? We have twins, and so we've had just like it's work, it's family, it's reading a little bit, and trying to get outdoors as much as possible, right? And so in new things, like for me, by the way, I think I like going back to early in the conversation, like I think about this, or like it's hard to identify this in another person, but like I think like thinking about this when we're hiring, and what the right sort of DNA is. Like I feel very fulfilled and like being on the steep part of the learning curve. So I really enjoy like picking up things that I am not good at or even remotely competent in, and trying to get good. And so I will continue to I will continue to do that. And in addition to the more recent one for me was golf, which I picked up at a late age. That's sort of a boring answer, but the piano will also happen once we're out of this phase. And I think the same way about skiing as well, which there's sort of like always something else you can get better at with it. And so in many ways, I feel like you're always on a steeper part of the on the learning curve with skiing. So yeah, those are just a few things, but
Well, I have good news. And maybe like, I don't know, I'm just gonna guess, like 14 years from now, you'll have the opportunity to do those things again.
That's
So
right.
like both of my kids are in college now, and all of a sudden I'm like, I can actually play the guitar. Okay. Like I actually have free time to golf or do like so it's so there's a light at the end of the tunnel, but it's
My
you
goal
got a
is
long
when the twins are 4, my oldest one will be like, we'll be able to start doing things together.
hmm
It doesn't change
Yeah.
reading,
Yeah, like
but by the
skiing
way, if I'm
and
not getting woke, if we're not getting woken up in the middle of the night, it's a lot easier to read at night before
right.
going to bed. And so, like, I think that will be a bigger part of it. And I, I, I love that aspect. And I don't think there's any better way to learn um, about new topics. Um, but like, I think that is when you can, get back into, it's not going to be the same, but like you can start to get back into activities and new activities based on, their interests, whatever they may be. So I'm excited for that.
Awesome. All right, Graham. Well, thanks so much for taking the time to bring us up to speed on the new fund, all the great work that you and everyone at the firm is up to, and obviously all the great advice.
Terrific. Really appreciate it, Keith. And yeah, keep going. 300 plus. Amazing.